Okay, can everyone hear me all right? This is your host, Tony, with Macro Ace. Is everyone able to hear me clearly and also see the screen clearly? So one of the things, so we've got about less than a minute left until we get underway. But one thing I want to do beforehand is, of course, share with you guys, if it is on YouTube, you do get a delayed video of the webinar. Naturally, there is a slight delay. But if you want to get the live real-time, if you want to sit here and watch the live real-time version of this webinar and be able to hear me much better as well, then you can join this link right here, which I've posted in the chat as well. But also for anyone who is a user who is using Macro Ace, there's also YouTube. So yeah, anyone who's using Macro Ace or has just gotten, or it's the first time that you're doing this or using us, remember, so Financial Juice is where this is all born from. And Financial Juice as a site and a place for traders to come and listen to real-time news and view real-time headlines and see economic releases and get economic releases lickety split really quickly as well. So for those of you who want to manage your trades or be aware of what's going on in the world, you can sign up to Financial Juice Pro, which if I bring down here, so you can sign up to Financial Juice Pro, and you can, which I'll put a link in the description on the chat here, to be able to get a 7-day free trial of our news service as well that you can have access to. So of course, 24-hour real-time, no delay. There's no advertising in the Pro version. You get access to the news desk, so you're able to ask people and ask our analyst questions about what's going on in the market, what are the latest headlines, and also we get real-time economic release triggers as well. So that's also another thing that you can get. So you can set your own triggers for your releases, and if it does meet your figures that you're looking for, then it will come up with a little buy or sell symbol on the side for you as well. So that's Financial Juice. As said, I've put the link in the YouTube chat for you, so you can have a look at that there. And then you have the FJ, and then you have Tick Strike as well. So if you want to listen to order flow, and if you imagine yourself that you're in the trading pit and you hear all the traders shouting buy at the beginning of the market open or sell, that is what Tick Strike in a way is. It lets you listen to order flow, and the more orders that are placed for buy or sell, the more sounds you're going to hear. So it's an audio based and also visual based product that you can have a look at and also try, which also has a 7-day free trial as well. So Tick Strike has been quite successful because it's helped traders it can help traders manage their trades. It can also help traders find opportunities in the markets where there might be a lot of movements going on, maybe in certain stocks such as Apple, Tesla, or maybe in commodities or in currencies and fixed income in the US as well. So that's Tick Strike there for you. Again, I'll put the link in the chat for you to have a look at that later on. Now, getting back to the nitty gritty, then let's start this presentation, and let's get this underway. So, consumer spending in the US. What is it? So it shows how much US consumers are spending on goods and services, the difference between CPI and PCE. So CPI, of course, measuring inflation in the US, as does PCE, so the Personal Consumption Expenditure Index. Now, the key difference between those is that PCE includes prices in rural areas as well as those paid by organizations that is spent on behalf of households. So that's one piece about PCE. The other bit about PCE price index, or the PCE release itself, is that it isn't restricted to a fixed basket of goods or services, right? So with the CPI, you have a fixed basket of goods and services that can't be changed for 2 years, whereas in the PC price index, you can change and chop and change what to look at in the report. So, for example, let's say the price of chicken meat was really expensive for some reason, or was really expensive for the last 2 months, and actually consumers went towards beef. Of course, that doesn't make sense. Beef would be more expensive, but just for the idea. But beef was less expensive than chicken. Okay, let's just say there's a shortages of chickens then. And from that shortage, and because beef is cheaper, consumers are going towards beef rather than chicken. Now, the CPI price index, or the CPI, won't change and look at beef prices. Instead, it will stick to looking at chicken prices, or the price of chicken meat. So that means that sometimes the inflation report can be overinflated, but more or less the PCE and CPI price index have a very similar correlation. They don't really deviate too much, more or less move in the same direction. The only difference is there might be a 0.2 or 0.1% difference in the figures, or if we're looking at an extraordinary amount of inflation, then that could mean that you could be seeing a bigger difference between the figures. So if we move on then. So how does it affect the markets? So with currency, a healthy increase in personal incomes and spending bodes well for the US dollar. A high consumer demand encourages more growth and puts upward pressure on interest rates. Of course, if there's more consumer spending within the economy, then that will lead to higher prices for the goods that consumers and services that consumers pay for. And in turn, of course, that turns into inflation. And then with high inflation, then the central bank can and might step in, as we've seen recently. We'll step in to slow down the rate of inflation or cool the economy, but not to try and stop the economy. So that's one reason why currencies usually prefer, or the dollar would usually prefer to see stronger spending in order to support a stronger dollar. For stocks, a higher personal income and spending is viewed favorably in the market because it fuels more economic activity and enlarges corporate profits. The main reason being, of course, you have the flip side of that when consumer spending becomes too much, whilst the economy is overheating and the central bank hasn't done anything to control or slow down the rate of acceleration in the economy or expansion in the economy. The higher consumer spending report could mean for stocks that at some point that the central bank could step in and be very aggressive with their tightening policy, i.e. it could be to raise rates by a big amount, or it could be that they could take away some stimulus from the treasuries market. So i.e. asset purchases, they can remove and start cutting that down. And the balance sheet, reducing the balance sheet is also quite a big factor in how a central bank supports an economy and supports money flow. So for stocks, on the flip side, that you could have a negative reaction instead if the markets or if the economy is overheating and central banks haven't done anything yet to curtail that high amount of spending. So for bonds, any data that affirms sluggishness in the economy is expected to support higher bond prices and lower yields. So now whenever the economy or traders are uncertain, or if there's uncertainty within the markets about how the economy is going to fare in the future, bonds usually see a higher amount of inflow, as it's the risk off sentiment that will drive the inflow to bonds instead. And of course, with supply and demand, the more traders or the more money that is pumped into, or more people buy bonds, the lower the yield goes and the higher the price goes. So a better than expected consumer spending report can mean that bond prices could go higher and yields can go lower. Whereas what can happen as well, if or of course on the flip side, if the economy is not doing well, then what can happen is that the yields could actually go higher and the bond prices can go lower. The main reason being is that with the government, what they'll look to do when they're providing their debt in the treasury market, or the government debt that they have, when the economy is not faring so well, they will increase the interest rate, or the interest that somebody could receive on, or the yield that somebody could receive for buying their debt, and they will also try and lower the price as well, to entice people to jump into the bond market. So that's one other thing that can be done, or that could happen in the bond market. So again, if data is worse than expected. One thing I wanted to also show as well is how the stock market or stock index has fared against when we've had PCE price or the PCE, or the personal or consumer spending month-to-month data. So of course you can see that you've had this dip in the S&P coinciding with consumer spending having a drop off, and then seeing the S&P and personal consumption or the consumer spending report see move back towards the upside. Then it gets quite interesting, where you see the opposite reaction in a lot of the cases in the market. So as you can see, if there's a dip here in the personal spending or US consumer spending, then you actually see a rise on the S&P 500. So this goes, of course, back nearly a couple of years back now. Wow, it's been 2 years, jeez, since we've had maybe about 2 years since we've had the start of the pandemic. But yes, so here what we've seen is that when consumer spending was lower, then you can see that the S&P moved higher. So that was a couple of years ago, I said. And then recently, we've had more of a bigger move, or slightly bigger deviation, let's say, or less of a correlation between PCE, or between the personal consumption and the S&P 500. So when central bankers or the Fed was starting to talk about tightening monetary policy, and that would be to remove stimulus because of strong consumer spending, or that consumers would fare well with stimulus was withdrawn from the economy, then what we've seen is that when we had a negative report for consumer spending, of course that helped. That meant that the idea that the Federal Reserve would take stronger action to tighten inflation, or to start putting away support for the economy, in actuality, you'd seen the S&P 500 see an appreciation instead. So again, the key reason being is, as said, if the economy is not doing well, that means that it might put off the timeline or extend the timeline for the Federal Reserve to take any tightening action. Hence, we've seen that reaction or difference there. And then again, you can see that there. So, of course, we're waiting for today's report. But so far, what we've seen recently has been compared to, as we can see here, the previous report. Now, what I also want to talk about is, so consumer spending growth was a major driver of the economy, but dropped substantially in February as the COVID Omicron case rise abated and inflation surged with Russia's invasion of Ukraine. And according to the Commerce Department, income after taxes adjusted for inflation decreased for the 7th consecutive month in February to the lowest level since March 2020. And the wave of COVID infections caused by Omicron variant faded in February, prompting consumers to spend more on services such as dining out and traveling. Also, consumers are providing conflicting signals about how they feel about the economy's direction. Consumers are positive about the economy and the labor market, according to the Conference Board Consumer Confidence Index, but they are apprehensive about the long-term effects of Russia's invasion of Ukraine on inflation. Of course, the key factor being when we're talking about inflation is energy prices and how much of that is going to be passed on to consumers. And a lot of the recent reports that we've seen from the CPO reports, energy has been mentioned more so, or has taken up, or has been a bigger driver of inflation reports. So these thoughts and views of these consumers, rightly so, to be cautious of if there's higher prices for like retail fuel or other foods as well, agricultural goods, and for businesses when they're creating goods with the metals that are being imported or from around the world. And that's also another worry too for businesses. Where is the economy at the moment? So inflation at a 40-year high at 8.5%. PC price index of the prior report, what we had 6.4% for year on year. Core PCE at 5.4%, the highest since 1983. Remember the PC price index, then another reason why it's important to look out for or keep an eye on is because it's one of the Federal Reserve's measures of how well inflation is doing in the economy, or how hot inflation is within the economy. That's their preferred method of looking at inflation, is via the PCE price index year on year, and also particularly the core PC price index. So I think, although we do have a headline figure of how consumer spending is within the economy, traders are going to be keeping an eye out on what the PC price index is going to be doing. Previous employment report, we'd seen non-farm payrolls was 431k versus the prior of 678k, forecast of 490k. Unemployment at 3.6% versus 3.8%. Q1 advanced GDP unexpectedly fell by 1.4% versus the prior of 6.9%. The forecast was 1%. So dollar and stocks no likey, i.e. the economy did worse than expected in the first quarter, leading to depreciation in the dollar as attractiveness would fade. And of course, for businesses as well, if Q1 GDP overall is worse than expected, then that means that the production or the productivity within the economy has seen a bit of a drop-off, or hasn't picked up as much steam as economists or had hoped for that. As said, they were looking for 1%, but there was an actual deviation of 2.4% from the forecast figure. So that, again, wasn't very positive for the markets yesterday in that short time period before it, after about 20 minutes or less, about 15 minutes, then it reversed its downward movement on the dollar. Consumer spending grew 0.7% for the quarter. Now remember, yesterday's report for GDP is, as said, is representing the quarterly rate or the annualized rate for economic releases. So if the economy came in at -1.44% for GDP, then the expected annualized rate of how quickly the economy is going to grow by would be at -1.4% so far for now, until we get other data coming in later. And then, of course, for consumer spending, it's similar as well. I think what we can kind of take, if that consumer spending was still up, even though inflation was ticking up, then that's going to be quite interesting to see how well consumer spending fares. Of course, we've had our first rate hike in the US, with going by 25 basis points to 0.5%, and the upcoming meeting next week, we're expecting a 50 basis point hike to 1%. So if consumer spending hasn't been affected so far, then we'll yet see what happens to that later on down the line. Inflation, again, so I'll make sure I try and be quick here. I think we're nearly done. So inflation bites. So US prices rising at fastest pace in 4 decades is tempering demand. So again, so if prices are rising, you can see, although you can see the consumer spending is seeing a little bit of a drop off, or is near enough flat, but there isn't too much of an increase in the consumer spending in the US economy, but it isn't really weak. So, but as we can see here from an image from Bloomberg, from them showing that the high consumer prices, the more of an effect it's having on, or the PC prices, the more effect it's having on consumer spending. Then views. So Bank of America saying that the future is obviously not as sunny as it was, and they expect growth to decline and consumer spending to follow suit. Bank of America strategists also said that significant withdrawals from US equity funds are just getting started as the Fed raises its hawkish rhetoric. 75 basis points is the new 25 basis points, according to Bank of America strategist Harnett. So this was a comment made a couple of weeks ago now, or last week. This comment was made. And the week to April 20th, investors poured $19.6 billion from US large caps, and which was the most since February 2018. S&P PMI data, companies selling lots of goods and services and raising prices at the same time, dampening demand. And JP Morgan says that there's lots of pent-up demand for spending, in particular in services. And Visa saying that if anything, discretionary spending among affluent consumers and credit cards has been healthily increasing. So in general, there isn't any evident impact on inflation. Okay, let's kind of go ahead. So we'll talk about, what about 8 minutes? Powell again talking about the possibility for a 50 basis point hike could be appropriate, and that's something that now traders have factored in or priced in, and traders are betting on a half-point hike in May, June, possibly July. Current sentiment, say Russia, Ukraine not having too much of an effect on the markets now, and you've also got tighter monetary policy and yields. If yields are going higher, then that's one thing to bear in mind, that if yields are higher, that means that usually investors are, that usually means that the Federal Reserve, of course, is tightening monetary policy, and there's a fear that that's going to tighten further. Of course, and as said, so the dollar loves Fed tightening. So markets are expecting in total of 250 basis points of rate hikes in this year so far. Also, you have China's lockdown, and that had affected crude oil and also the market as well. That if China is in lockdown mode, what does that do for consumer spending? And also, what does that do for trade as well with other nations, which didn't have a positive effect on the markets. We'd actually seen a move towards the downside or risk-off reaction to the China lockdown. In response to that, however, China did decrease their reserve requirement ratio, or the amount of money that banks in China are supposed to hold on to. And in turn, that had eased some of the risk off sentiment. And then Morgan Stanley warning that the S&P is about to drop sharply, that investors struggle to find havens amid fears that aggressive Fed action will engineer recession. So again, the more positive data that there is for consumer spending, and the PC price index as well, to tighten or to bring in inflation, that's having more of a negative effect on indexes and stock indexes. So according to them, they say strategists said a quickly tightening Fed is looking right in the teeth of the slowdown, and that crowded defensive stocks no longer pay. So could that mean everyone else goes to yields instead? Which, of course, as I said, the more people buying, more investors buy yields, the lower the yield goes and the higher the price goes as well. And then that was to do with China. The Kurt has said it's to increase banks' capabilities of forex fund use. Okay, so market reactions. Let's have a little peek. So let me go back a little bit. Now, I'll be quick with the deviations too. Okay, so what we had seen when we had the consumer spending report, if I let it play, we've got about 4 minutes left. Okay, so the initial jobless claims data, and then it takes quite a while for the other bit of data to come out. Okay, so consumer spending was out, and then we'd seen, so it was worse than expected. So what we'd seen on the dollar yen, we'd seen a move towards the downside there. Gold has seen a quick flash towards the upside for that release. The S&P initially saw some movement towards the downside, but then saw some movement towards the upside after the release. So again, now our deviation of what we're looking for was about 0.5 for that release. The main reason being is anything lower than that, but where we got 0.3 deviation, we didn't get a very strong reaction in the markets. So if I just pause the video and let's go to our triggers. Okay, so spending, we're looking for a high estimate of 1.2% with a low of minus 0.5%. Personal income with a high of 0.7% with a low of 0.1%. PC price index month to month, we're looking for a high of 1.1% and a low of 0.7%. PC price index year on year, we're looking for a high of 7.3% with a low of 6.5%. Core PC prices month to month, we're looking for a high of 0.4% with a low of 0.2%. And core PC price index year on year, high estimate of 5.5% with a low of 5.2%. So don't forget, you've got the PC price index year on year. That is a key focus, and the core PC price index year on year, that is also a key focus for the central bank. I've got 2 minutes. So this is the last reaction. We've seen about initially about 8 ticks down on the S&P 500 and move towards the upside on the next candle. Then Q's seen about 49 ticks down initially. And then on the dollar yen, we've seen about 8.5 pips down. Cable 4 pips up. Euro dollar 2 pips up. And then 2.5 pips down dollar CAD. Aussie dollar about the same. New Zealand dollar also similar, about 2 pips down. Gold had seen about 17 ticks up. 2 ticks up on the 2 year and on the 3rd year as well. So that was when data was slightly wasn't great. It's more mixed, so didn't really get a strong reaction. We got about a minute left till the release. Okay, so let's go to Oh, child. Let's go to the site. So just also one thing to note, if we do get, we don't really get too much of a deviation, we could see that the markets might not react, or we could see the opposite, where actually the S&P could potentially see more of a positive reaction. We've got about 10 seconds. Actually, let me bring that up a little bit more. Okay. Hopefully everyone can see that. Okay, so Canadian GDP. Okay, right. Something's going, so the S&P is going down, dollar's going up. Personal income 0.5. Employment costs 1.4%. Okay, there we go. Okay, 1.1% for consumer spending. That is much better than expected. Also, if we're looking at, so yeah, again, 1.1%, much better than expected. Real personal consumption at 2%, better than expected. PC price index year on year, slightly lower than expected at 6.6%. We find the core PC price index also slightly worse than expected at 5.2%. Okay, so dollar yen, seeing some movement towards the upside there. S&P had seen some downside. Gold movement towards the downside too. We've got our eye on tick strike as well. Okay. And so that's the 2-year bond. Let's look at gold. Gold, more of a mixed reaction from that release. So overall, a much better consumer spending report that we had seen. So we're looking for a high of 1.2%, and then near enough, well, quite close to that. So the market's seeing a bit more of a risk-off reaction in the markets here. So as we can see, gold moving towards the downside now. As we can see, bond prices going. We can also see the bond prices going lower actually off of this data here. That's a 2-year bond. All right, let's measure some of these. Let's measure the reactions. Also, want to keep an eye out for the other currencies too, but let's do ones here. All right, so it's seen about 18.5 pips, or about 18.5 pips towards the upside on the dollar yen. Okay, the dollar yen still going up. All right. Let's look at the S&P. Oh. Okay, so that's about 44 ticks towards the downside. Gold, let's keep an eye on what you're doing. I can see. Whoop. There we go. Could not see. All right, this is a bit more of a mixed reaction, but overall the candle finished positive with about 11 ticks up. And then we'd seen what it did initially. About 33, or the other bit of move we'd seen, so about 33 or 34 ticks was the downside, but finished positive there. And then on the 2-year, two-year bond. Whoops. That's what I wanted. There we go. It's about 25 ticks towards the downside there. Right, let's have a look at some of the other currencies then. See euro dollar. Okay, so euro dollar didn't see too much movement there. Also just very, very conscious if there's any other bits of news, which there wasn't at the same time. The euro dollar, it's about 7 pip move towards the downside. Or 7.5 pips. Cable. Uh, 31 cable. Again, similarly 7.5 pips towards the upside. Where was that? Hmm. 8 pips. Okay. All right. Now I'm recognizing a clear pattern here. That's about 12 pips. Okay, so I think we've also got to remember with the Edgar Gabaldi says thanks for the live, no problem. I appreciate if you enjoyed it and you liked it, that's great. But yes, I think one of the main things I think why the dollar yen has moved or has seen a bigger move is with the Bank of Japan being more dovish in their monetary policy, or looser in their monetary policy, i.e. they're of course looking to try and control the yield curve to try and keep bond yields in control and not let them go too high to the point where the Bank of Japan would have to raise rates in order to bring them down as another way to do that. But you have the market pressure overall of mixed reaction of Fed central bank tightening that is increasing the yield that on bonds overall globally in other countries too. So for Japan not doing that, that's putting pressure on Japanese bonds. Hence, we'd seen yen weakness, or a lot of yen weakness overall in the markets recently, but the dollar yen seeing a bigger move compared to the other currency pairs, where in actuality not really getting too much reaction, to be fair, on those on the release itself. So dollar yen was the bigger move there. The S&P, okay, so that's still down. What's it down by now? That's about 49 ticks, and it reached, what did it get to? Got to around 66 ticks towards the downside. Let's look at the NQ. That's one thing I don't want to miss out. Okay, similar reaction to the downside. Right, 31. And that's about 198 ticks towards the downside there on the NQ. So if you remember, we'd seen at least about a 0.5 deviation. If you remember the last release that we talked about, we're looking for about 0.5. Here we're about, they were slightly updated from economist's point of view at 1.2. But yes, so it did reach our target, slightly just about a point shy of economist at 1.2%. But yes, there we go. That is the reaction. Remember, so financial juice, as said, don't forget you can sign up to Financial Juice Pro, give it a week trial, and if you like listening into real live news and seeing data in real time and staying abreast with what's going on, so you're able to manage your trades better or manage your risk better, then sign up to that free trial and give it a go. Remember, a lot of these investment banks and a lot of the big traders will listen in to a squawk, okay, or real live voice news service, or they have someone like me telling them what's going on in the markets, with the headlines that are coming out and what to expect. That's high level. That's something that not the everyday trader gets, because it's something that they haven't maybe not heard of, or maybe it's quite expensive, and it's very for someone to take that on. But a financial juice, what we do have, you have of course the live version of the feed, but that includes ads, is delayed, and you don't get real-time economic triggers, and you don't get to have access to the news desk to ask questions about what's going on in the markets. But with the pro version, you can do that. You can do all of those things and get rid of the ads and be at the level of what investment banks are at the level of getting headlines and data. So if you're looking to stay on top of your game or up your game and try and be like an investment banker, or hopefully not a risk taking, hopefully not going too nuts, becoming not trying to become a whale, putting all your money into one trade. Well, I'm sure they don't, or having a fat finger, let's say, or if you've accidentally pressed, if you bought or sold something. But if you want to up your game, then definitely do check out Financial Juice with the pro free trial that we have. All right, ladies and gentlemen, thank you very much for joining me. That is all. I'll be posting out the video for this, or this replay, to our mailing list, and also I'll be providing the week ahead. So remember, we've got FOMC, Bank of England interest rate decision. We've got non-farm payrolls, get ISM and EIA inventories data. So quite a stacked week, a very important week for us next week and the markets. All right, thank you very much. Goodbye.